Hi, this is Roger Conrad. I'm co-editor of Vital Resource Investor with Yiannis Mostrous. And what I want to talk to you today about is the pullback in raw materials in general and commodities, and why I think this will be a temporary pothole in the road to a longer-term bull market. And maybe a couple of the opportunities that should be looked at right now. Certainly this is a very volatile sector. It started this decade very much in the doldrums, just as energy prices did. We really went through about a 20-year bear market that began in the early 1980s. At the end of that, which was at that time a very major boom, higher prices for things like copper, like iron ore, as well as energy, really entered a major tailspin because a lot more supply came online. Higher prices did that by encouraging new spending, new production, new output, and then higher prices also discouraged usage. So you had a lot of permanent demand destruction there, and things went from really bad to worse for the sector. You had a tremendous shakeout, tremendous amounts of money lost, a little bit of a bounce for some things like gold in the late 1980s, but really since then pretty much an uninterrupted bear market that really reached a bottom or a nadir in the late 1990s. Now, of course, when you have a major period of a long-term period of low prices, what does that encourage? Well, a lot more usage. It also discourages new production, new spending. So eventually things unwind. You reach a bottom here, and supply pressures, demand pressures start to exceed what's going on. So then you have higher and higher prices, and that's basically where we've been the last 4 or 5 years. Now, there's a lot of chatter right now about that this might be coming to an end. I think there's a couple of things, though, that really bear keeping in mind as this plays out, because as you have weaker economic growth in the United States, traditionally you meant a bear market for raw materials. Prices have really come down hard. The U.S. has been the major market for things like copper for a very long time. So that's what people are really used to seeing, and I think that's one reason why the stocks, raw material stocks, have really come down in a big way, really ahead of the actual prices of the commodities, which have remained relatively robust. But there's really two things that are different and make this pullback. Gives it all the characteristics of a short-term phenomenon rather than the beginning of the end for the material bear market. And again, it all comes down to supply and demand. In order to bring commodity prices down, price for any commodity down in any meaningful way, you've got to have tremendous investment in new production, and you also have switched to alternatives, and you have to have meaningful conservation, things that permanently reduce permanent demand destruction, not just reductions in demand due to economic factors, which history shows are often reversed. So what are those factors? Well, on the demand side, we have tremendous demand from developing countries, particularly China, which is massively building infrastructure, millions of people moving from the country to the city every year, and that means you have to keep building. You got to build buildings, you got to build roads, you got to have energy infrastructure in place, and all these things require massive amounts of raw material. So that's really why China and the U.S. have basically reversed roles for many of these commodities. About 5 years ago, the U.S. used about 25% or accounted for about 25% of the world's annual copper demand, and China was about 12%. Now those percentages are actually reversed, and in other words, China is now twice as important to the copper market than the U.S. I don't believe that's really fully factored in. Right now, you've seen, or at the beginning of this bear market in general equities that began in the middle of last year, you saw a lot of expectation that raw materials demand was going to come down just from the U.S., so you're going to have prices coming down and so forth. That didn't materialize. Now the bear argument has shifted to, well, the weakness in the U.S. is going to spread to the developing world, particularly China, and thereby bring down demand and thereby bring down prices. And I don't think you can wholly discount that, but in any case, it will prove to be a short-term factor, because those long-term needs of building out those cities remain very, very critical for countries like China and also countries like India and the rest of Asia, also Eastern and Central Europe. So there is tremendous call on these resources, and that's not going to be something that's just going to disappear if we have slower economic growth in this country spread to other areas. The second big factor that really makes us think that this is going to be a long-term trend is on the supply side. And as demand for commodities has grown, at the same time, the old traditional stores of commodities, the ones that really sustained things during the 90s when prices were lower, those are starting to run dry. So companies are having to go deeper and further to get commodities like copper. They're having to spend more money, and that means going to places in the world where there isn't developed infrastructure. It means going to places where maybe the political situation is somewhat unstable, particularly in many of the African countries, which have large provisions. And also you have the rise of resource nationalism, which is basically host countries wanting to get a bigger cut of what comes out of the ground from their countries. And all these things push up the price of producing these things, which means that you have to have a higher baseline price for commodities in order to make these projects worthwhile. So any major decline in prices for whatever reason, even if it's a short-term recession-related reason, is going to shut off production of a lot of things and immediately restore the supply-demand balance on the side of producers and away from consumers. In order to go the other way, you've really got to have, again, that permanent demand destruction and a lot more investment. And history shows these trends tend to last a long time, many years, and this one may last even longer, again, because of the nature of where the demand's coming from, these countries that really need to develop infrastructure and really build for larger urban populations. So what does this mean? Well, I think it means that there's a lot of opportunity, particularly in some of the larger resource companies out there, Freeport Copper and Gold being one, Rio Tinto, another big one. You don't really have to go very far off the beaten path to get these things, I think, and you can get them at very good prices right now where everybody's concerned about the impact of a near-term recession. And again, these things are pricing it in already. So that's my message for you today. Again, thanks for tuning in. Look forward to chatting with you next time.